Introducing SilverBiotics, the preferred colloidal silver supplement of the doc. See SilverDoctors.com for details and special promotional offers today, including a specially formulated 30 parts per million, only available from the doc and other healthcare professionals.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets. Well, Eric, the second quarter of 2013 has come to a close, and frankly, it couldn't come soon enough for gold and silver investors. Both metals had what can only be described as panic-driven capitulation losses this week, as gold was driven to a record quarterly decline in as low as $11.86 early Friday morning, and silver was down another $3 to as low as $18.20 on Asia trading Friday. And after another rate attempt on the COMEX Open today, however, both metals roared higher throughout the session Friday, with silver up just about $1.50 off its lows, nearly 10% in under 24 hours, and gold was up $50 to $12.35. And really both metals were closing on their highs into the close in the access market late Friday afternoon. By all accounts, it's been a historic week in the metals, hasn't it, Eric?
It has. I was actually expecting metals to show some downside action today just because of what the heck, the cartel could put a punctuation mark on their performance for the whole month and books would be closed out, but I guess to some extent short covering interest by hedge funds, their Pavlovian cohorts that they've been bringing along for this entire ride down is part of what we see today. But more interesting, if you actually look at the price action, particularly with silver in the London trading hours going into the London PM fix, that big spike that started well before the fix was coming in is suggestive of the fact that somebody needed to procure a good chunk of silver out of the LBMA inventory system, and the only way they were going to get it was to offer up more money. So the price shot up. That kind of action suggests that the market is tighter there now than it was earlier in the week, vis-a-vis the general indications of where the buyers and sellers are lining up in their queue to do their business. This has been a really painful period. We keep seeing these little anecdotal snapshots that suggest that we're in a bottoming out process, but then the cartel comes up with another hissy fit and we start all over again. Maybe this isn't the bottom in the ultimate sense, but it sure feels like it. Sentiment has never been lower in this entire bull market, no matter what metric you look at. Certainly is the case that JP Morgan's net position on their silver holdings is in the money for sure, given this latest decline, as they were most likely shorting into it. They really, once again, don't have a huge amount of incentive to crash the market further, but that was the case even back when we were looking at 22 silver holding for almost 2 months. Unless there's something really just unbelievably negative that the bullion banks are impelled to crash the markets down further as a shock absorber strategy vis-a-vis whatever may be the black swans that they're fearful of. This does not seem that the market will continue to go down and down and down indefinitely because physical market demand remains strong in Asia. And we document some of that further in the write-up. There's interesting information out of the LBMA today that we can talk about maybe a little bit later in the show. But the bottom line is that bear market cycles are painful, but they don't go on forever, and there will be a bottom at some point, and investors just need to look at their positions in precious metals under two categories. One being your insurance that you are buying because you want to be able to survive any kind of massive turmoil in the system, and then the section of your wealth that you might want to deploy for speculation purposes. Our listeners and our readers get into a position that's too aggressive. It's not as easy to go through periods like the one that we're going through now, and it's really important to be able to sustain the long haul as stackers in particular and not get pushed out by bear markets, because they definitely would like to buck everyone out of their positions, that's for sure.
Going back to touch on what you're commenting with the sentiment being the lowest it's been in the entire bull market, it's really amazing to me how bad the sentiment is and across all spectrums, from whether it's blogs like SilverDoctors or Zero Hedge or TF Metals throughout the mainstream. The sentiment is, institutional investors just across the board, sentiment is below zero if it could be below zero. Investors who have been longtime stackers and holders of physical bullion. Their emotions, understandably so, with silver now down, 60% from the highs, and gold also, I think, overnight last night came within $1 or $2 of the Fibonacci retracement level. It's about 61% off of its high around 1925. Everything I've seen, whether it's comments, emails I'm getting, it's just a sentiment of investors thinking we could go lower. It's just bitterness, anger, resentment, and I really can't imagine sentiment getting any worse. So again, that doesn't mean necessarily we can't go lower price-wise, but it's a pretty good indicator that we are very near a bottom with a level of really animosity towards the metals right now. But really, from a longer-term perspective, times like this is really where the most wealth is created if you're able to, hold your stomach, be right, sit tight, and not only just be right and sit tight, but have the dry powder and capital available, resources to add to positions and make new positions. The mining stocks have already seen just total capitulation. A couple of the stocks that I've been looking at were up like 15 to 20% today. Really, in the long-term fundamentals, the Western financial system has made it clear that bail-ins are coming. I mean, either QE will ramp up higher again, as Eric has suggested it could happen within 3 to 6 months after a Fed taper, as just the wheels come off the economic system.
It's actually kind of funny because when I penned that comment about the tapering in September, that was prior to this latest FOMC release and the press conference that Bernanke suggested that we would be cutting all taper, forgetting about tapering, but ending the whole QE program as early as sometime in 2014, and that's really the big surprise that the market was digesting throughout this last 10-day period. It also speaks to the degree of confusion that's out in the investor space, because a lot of people were actually complaining that Bernanke did not make many changes in his speech and in the tone of the tapering offering. But in fact he did, because 2014 termination of the program would be pretty aggressive in terms of time schedule for their target, and it is indeed just a target. They're just throwing that out there. But this whole week we've seen a parade of more of the doves come out from Dudley and other folks in the Fed speaking to the program going on longer. So, it's all a game of jawboning and management of public perceptions when it comes to inflation expectations and liquidity expectations for the market continuing. And Bernanke was reacting to the fact that, by the end of this year, we're on track for a $4 trillion balance sheet at the Federal Reserve, and people are looking around justifiably saying, what's going to happen to interest rates over the long term as the Fed begins to become the entire market for the intermediate and long-term bonds with such a big balance sheet? And that issue remains, and that's part of the reason why QE to infinity is going to be the catchphrase with us for quite some time. They may be able to taper, but they will not be able to end the program. Gold in the long term and silver as well will follow the level of debt that we add on to the Fed's balance sheet. And even if it's sequestered in the Fed's balance sheet for a period of time, as opposed to going out in the economy and increasing velocity of money and signs of inflation and so forth, the debt that's being created still matters, and it's going to push the price of gold up over the long term. That's just a correlation that powers that be cannot turn off indefinitely. We have a chart of that as well in this write-up for this week. It's going to be a long summer.
Right. We still have the debt limit crisis looming later in the summer, potentially. And really what the Fed is risking here with their attempt to mope the market with their threats of taper, or even temporarily taper, they're really risking losing control of the bond market. And we've seen that just over the last week since they've threatened to taper or stop QE within a year, 12 months out. I mean, interest rates have jumped a historic amount, nearly 1%. So they're really risking losing control of the bond market.
And they know it, and that's why they've been out all week talking down the whole risk of tapering too early. It's just going to be a back and forth kind of process, and at this point, hopefully the metals have bottomed, because if you keep falling much more below like 20% the cost of production for gold and silver, you'll see countless mining companies close. I mean, there's probably more than 1,200 or so venture exchange listed junior mining companies, and the better part of half of those with within the next couple of months are going to close because they don't have enough cash to operate and continue on their exploration. And even though a lot of their projects may not have necessarily been something that would bear fruit, this whole contraction of the supply side of the market is something that pretty much nobody in the mainstream media is talking about. I mean, you'll hear about it on the blog space in places like SilverDoctors. An unknown bullish factor to the market that will probably remove maybe as much as 20% of the mine supply 2 years from now.
Right.
Compared to this year's level of production in both gold and silver.
Peter Schiff brought it up on CNBC Thursday and tried to make that point that gold just can't stay under 1,200 for any length of time, or really the mining sector is going to be driven out of business. And he was laughed out of town on CNBC, which isn't too surprising. But other than someone like Peter Schiff who gets on CNBC, the mainstream is not talking about that at all.
Yeah, and Barrick's all-in costs are at least $1,500, and in South Africa, their all-in costs are that high as well, if not higher, for certain mining companies. So, I mean, we're at a level now where almost the entire South African gold production can go off stream in the next year, and people are talking about this being a long-term bear market. And it's just, the demand for bullion remains high worldwide on a net basis. Supply is going to get crunched. And the fundamentals when it comes to the turmoil in the financial markets remain positive. So the bottom line is that, at least from an insurance argument, there is no argument to ditch one stack at this point. There's, every reason to believe that we are in a stronger position now vis-a-vis the next 5 years going forward than even last year's picture.
It's going to be pretty interesting to see the numbers of gold imported from Hong Kong for June when they come out in another month or two. It's going to be astronomical, and I'm guessing it's going to put April and May, just blow it out of the ballpark. It's going to be pretty unbelievable. I want to get into here the supply situation, the retail side over here in the U.S. We have been talking over the last several weeks that the shortage, at least on the silver side, retail shortage had been easing up quite a bit prior to this most recent smash to down towards 18. So this week, with the break of 20 and the trip down towards 18, we saw premiums on the Silver Eagles on the wholesale side jump really about 50 cents to $1. We saw delays pop back up. Most of the wholesalers are now running about 4 to 5 weeks out on Eagles as of Friday night here, the 28th, whereas a week ago, most of them had Eagles live. Premiums on the Silver Maples jumped also probably about 50 to 75 cents as well. And the wholesalers are, again, with the Maples running at about a 3 to 4 week delay depending on the supplier. So really just 5 or 6 business days ago, most of the wholesale suppliers and the primary dealers for the mint had silver in stock pretty much across the board, whether it's rounds, bars, and the mint products like the Eagles and the Maples. But with this latest plunge, we've seen the retail shortage kind of pop back up this week, although it is not quite as severe yet as we saw in late April, early May, where we saw premiums rise really about $2 to $3 on the wholesale side, and we were looking at 2 to 3 month delays from a few of the suppliers. So we're not quite there yet. It wouldn't take much longer, though, if with another trip back, if the bottom's not in and 18 is revisited or broken, I have no doubt we'd see that in another day or two. So going into next week here, we'll keep an eye on both of the metals prices. Promising close today on Friday with gold closing up at $12.35 and silver heading up towards $19.70. We'd like to see a continuation of the move today into Monday and Tuesday. It's a little too early yet to call it bottom with any conviction, but the early signs are promising. So should be another interesting week next week. Hopefully not quite as interesting as this week, Eric. But for the Doc and Eric Dubin, thanks for tuning in to the SD Weekly Metals and Markets.
SD Bullion.